Good afternoon, and wishing you and your team a very happy Diwali. Thank you so much for being with us today and joining us to talk about your earnings. First of all, let's start by talking about loan growth. Loan growth has been exceptionally strong for you. Scope for upside surprise to loan growth for FY27, if you could help us with any outlook over there.
Yeah, thank you so much for having me. Thank you so much for having me here. So, happy Diwali to the entire team of ET Now and
Thank
the
you, sir.
viewers. As far as the loan growth is concerned, you have already seen that the loan growth is quite robust for us. Global loan growth has been at around 14%, and the domestic loan growth is also quite robust for us. As far as the RAM book is concerned, there in agriculture, we are growing at around 13%, MSME at around 16%, and retail credit also we are growing at around 19%. The entire RAM book is growing at around 17%. And as far as the corporate book is concerned, there also we are having a double-digit growth, credit growth. So as far as the FY26 numbers are concerned on the credit growth side, I can say that we have a very strong pipeline. Our pipeline is more than 70,000 crores as I speak. And out of that, and it is nearly 10% of the global credit book which is there. So we have a lot of good disbursals which will be there in the Q2 and Q3 and Q4. Basically, what I can say is the H2 numbers would be much better than the H1 numbers as far as the credit growth is concerned.
So credit growth is likely to improve in the second half of the year. Good afternoon, Ashesha this side, and season's greetings to you and your team. Let's also talk about net interest margins then. They've contracted this quarter to come in at 2.41% versus 2.55% that the company had reported in the previous quarter. What will the trajectory for margins be for the second half, and do you expect reversal after the decline that we've seen in the last quarter?
Yeah, as you rightly said that the NIMs have come down and we have closed the global NIM at around 2.41%. However, if you see, because we have 15% of our book, which is an international book, our overall global NIM is like at 2.41, but the domestic NIM is at a healthy 2.61%. And as far as the going forward NIM is concerned in Q3 and Q4, the entire repo rate cut, which was the last cut which had happened in the month of June 25, the entire repo rate impact has been taken in the Q2 quarter as far as the asset side is concerned. As far as the liability side is concerned, there is still some repricing left over on the particularly on the term deposit side. There we are expecting that there will be more transmission happening and moderation happening in the Q2, Q3 numbers. And we feel that from the Q4, the NIMs should start improving for us.
Okay, so hopeful of NIM improvement going ahead. That's the word coming in from Mr. Karnatak. Mr. Karnatak, also help us understand the impact of the ECL norms that we've seen. How much cumulatively is to be provided between FY27, 31, and what is this going to shape up, or what is this going to do to your provisions?
Yeah, so as far as the ECL guidelines are concerned, you are aware that it's a draft guideline issued by the RBI. So our team is also working on it. See, it is effective from 1st April 2027 and the effect goes up to 31st March 2031. So as far as the stage 1, stage 2, stage 3 assets are concerned, so we have done some ballpark calculation, though it is a very initial number over there in stage 1 and stage 2. The lifetime PD has to be taken in stage 2, in stage 1 up to 12 months is there. And the exact numbers at this juncture, I will not be able to give in crores, but definitely on the CRAR impact side, I can say that the impact should be at around 0.75% only because we have healthy profitability. So there will be some uptick as far as the credit cost is concerned because of these provisions, though their provisions will not be much on the stage 3. But yes, on the credit cost side, there will be some uptick. On the CRAR side, there may be an impact of around, say, 0.75%.
Sir, that was exactly my next question with respect to credit costs. They've come in at about 0.28% in the quarter gone by. But if you can tell us how were recoveries in the second quarter and how much impact of recoveries did we see on credit costs?
So credit costs we have improved in this quarter, as you rightly said, at 0.28%. Earlier, it was much higher. And if you see our trajectory on the credit cost side, we have been bringing down the credit cost on a quarter-on-quarter basis, and this quarter being at only 0.28. One of the reasons for that is also the low fresh slippages which happened in this quarter, and we have been able to contain our fresh slippages, and asset quality is improving. Our fresh slippage in this quarter was only 0.14% and below 900 crores in the entire quarter. Apart from that, our SMA numbers are also improving from 7,600 crores as on September 24, when the numbers were at nearly above 1% of the standard book. In the September 24 quarter, it has come to around 6,100 crores only in the SMA, which is below the 1% mark. So considering the fact that the asset quality in the bank is improving, definitely the credit cost should come down, and we had closed the credit cost at around 0.76 in FY25, and it should be much lower than that in FY26.
So, Mr. Karnatak, just so that we have clarity, you are expecting your credit cost in the second half to be lower than what we've seen in the first half. Okay, if you could just repeat that point for us.
Yeah, definitely. So the credit cost, what we have seen in the first half of this financial year, should be lower than the credit cost in the second half.
Okay, Mr. Karnatak, thank you so much for your time today. Hoping for many good quarters for you, and hoping to keep interacting with you after every quarterly earnings as well. But thanks so much for your time, and once again wishing you and your team a very happy Diwali.
Thank you so much, and happy Diwali to you and